Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. I want to thank you for joining us. If you find these videos helpful and informative, I want to encourage you to like the video and subscribe to the channel. Also, take a minute and check out some of the other great content that we post on a regular basis. So with that said, as always, my purpose for these videos is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. So as we always do, we'll start by taking a look back at last week. Although a lot of the information I'm going to share is about jobs, I do have one quick update to share from last week. The only major tariff action that we saw last week was an increase in steel and aluminum tariffs from 25% to 50%. We don't necessarily know the impact this will have on the economy, but we have already started to see steel and aluminum prices rising since the implementation of the new tariff. Turning our attention to the job market, there was a lot of job information this week, but unfortunately, as has been the case with previous months, it was a relatively mixed bag of results. So first and foremost, we saw the weekly unemployment insurance claims data for last week, where we saw the initial claims increase to an 8-month high, while we saw continuing claims drop below their recent highs. We also saw the job openings and labor turnover survey produced by the Bureau of Labor Statistics, which showed an increased churn in the month of April, meaning that we saw job openings, hiring, and separation all increase slightly from their previous March values. Additionally, we also saw the ADP private employment report, which was really the first indication of trouble early on last week, as the report came in suggesting that only about 37,000 jobs were added in the month of May, while the expectation had been closer to 100,000 jobs. So this report significantly disappointed markets and caused some unrest among economists and analysts regarding the slowdown of the economy. Towards the end of the week, we saw the National Unemployment Report from the Bureau of Labor Statistics. The report actually came in better than expected, with the expected number of jobs being around 125,000 and the actual number of jobs created in the month of May being closer to 139,000. We also saw the unemployment report stay at 4.2% for the third straight month. In addition to this information, we did see a slight increase in the number of short-term unemployed, meaning those unemployed for less than 5 weeks. And we also saw downward revisions to the March and April job numbers of about 95,000 jobs in total. As I mentioned before, this unemployment report was a relatively mixed bag. The headline numbers were a little bit better than expected, but showed a continued slowdown, albeit at a very moderate pace in the labor market. We also saw some concerning aspects that'll draw our attention in employment reports going forwards. Specifically, we saw the employment population ratio and the labor force participation rate both fall by significant amounts. We saw 800,000 people, workers, join the not in the labor force category. We saw 625,000 workers leave the labor force. We saw 700,000 workers leave the category of employed workers. And we saw 71,000 new workers joined the category of unemployed workers. So although the headline numbers were strong, there is reason for concern and continued monitoring in future unemployment reports. Turning our attention to some other general economic data, we saw construction spending and new factory orders both decline in the month of April, significantly more than analysts had expected. We also saw the trade balance in goods and services decline by a historic amount, in large part driven by a nearly 50% pullback as far as imports are concerned. We also saw regular monthly reports on manufacturing and services coming out of the S&P Global and the Institute for Supply Management distributed for the month of May. Unfortunately, they were slightly in conflict, although neither one showed a major significant move. The ISM report showed an ongoing contraction in both manufacturing and services, with the service contraction being the first time we've seen this since June of 2024. The S&P Global report, on the other hand, showed a slight improvement in both manufacturing and services. Ultimately, both reports, although showing a slight contrast, had certain elements that they had in common. Business activity indexes were contracting. New orders indexes remained in contraction territory, and both prices paid for inputs and prices charged for outputs increased significantly in both reports. Turning our attention to the stock market, the interesting phenomenon of late is that the stock markets seem to be somewhat oblivious to the ongoing weakness in manufacturing and the ongoing slowdown in the labor market. Some analysts believe that investors have ultimately declared victory on the fight against inflation and are expecting the Federal Reserve to start to cut rates soon in response. Along these same lines, we've seen the volatility index, or the VIX, fall and maintain in relatively normal ranges over the last few weeks, as the market seems to be responding to near-term headlines and earnings reports more than a larger, ongoing, prolonged concern with trade, tariffs, or fiscal policy. All three of the major stock indices ended the week up, in large part in response to a significant rally on Friday following the better-than-expected jobs report. With that said, we have seen ongoing stagnation in the small-cap Russell 2000 index, and we have seen increased volatility in other markets, such as the fixed income and 10-year Treasury markets. Speaking of the 10-year Treasury, this week we saw the yield on the 10-year Treasury ultimately stagnate around 4.4% before dropping on Wednesday to approximately 4.3%, and then rising on Friday back to end the week around 4.5%. Also, one more important note, keep in mind that when Treasury yields go up, bond prices or Treasury prices are going down. Taking another look at some of our alternative markets, we saw an unusual amount of stability in the price of Bitcoin this week, ultimately fluctuating between $104,000 and $106,000, ending the week around $105,000 if we ignore a significant drop and then recovery Thursday afternoon. We also saw the price of crude oil rise throughout the week, ultimately increasing by more than 6% in the span of 1 week. And this is in spite of ongoing concerns about oversupply of crude oil and ongoing concerns about a larger global economic slowdown. We also saw in the market for the US dollar, the value of the dollar rise and fall slightly throughout the week, ultimately ending the week just above where it started. Last but not least, we have our historical safe haven asset, the market for gold. Early in the week, we saw the price of gold rising, ultimately rising above the $3,400 mark again, before falling back down later in the week, ending at about $3,300. Looking ahead to this week will be a big inflation week. In fact, we'll see the consumer price index for May and the producer price index report for May, both a little bit later in the week. And of course, right now, all eyes are on every inflation report as the markets, analysts, and economists continue to monitor for signs that tariff activity through April and May have led to increased costs and ultimately increased prices to consumers. Also this week, we'll see information on our weekly unemployment insurance claims, as well as preliminary data on the June consumer sentiment. Both of these reports have garnered a lot more attention lately. The unemployment report has become our most frequent and most common gauge of any sort of slowdown or tightness in the labor market, while the consumer sentiment report has shown significant rapid decline in consumer sentiment about employment, income, and inflation. So these two reports this week will both garner a lot of attention as we watch for continued indicators or signs of economic slowdown and tariff impact. Looking further out into the future, up to this point, we've seen a strong labor market with a slight slowdown, but no serious deterioration. We've also seen ongoing strength in the personal income data and the consumer spending data. All three of these areas have helped to alleviate and reduce some of the early pessimism and fear that occurred surrounding economic slowdown and the potential for a recession. With that in mind, as we move forwards over the next 2 or 3 months, moving through second quarter and into the third quarter, it is possible that if we start to perceive weakness in any of these three areas, we could see a rapid reversal of fortunes and attitudes, and we could see a return to increasing pessimism and recession fear. So looking forward in the long term, we continue to watch all the reports and any information coming out about the labor market, personal income, and consumer spending. So with that said, join us again next week as we summarize the mountains of economic data and analysis that are being published on a regular basis, do our best to bring you the important information in an easy-to-understand format so you can make informed decisions. As always, we'll bring you updated information on the economy and the financial markets so you can stay up to speed on the markets. And with that said, thank you again for joining us. Good luck this week, and we'll see you in next week's video.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.